right where we left off last week, right? The goal of the last couple weeks is to look at the macro cycles all the way down to the micro cycles. We're going to look at micro cycles tonight. It's the last segment. The idea is for you to walk up to a chart, look at it, and go, I know what it's going to do next. All right, pop quiz. What's the next plausible move? Anybody? Yep, people are saying short. Absolutely. You got 3 days of higher prices, consolidating around the high, right? You got 1, 2, 3. Everybody and their mother's in there. They're long. I checked my mom the other day. She told me she was holding long. I'm like, look, time to reverse. Okay, what do you expect? Okay, they're trading above the high swing. Look like they're forming an M here. Stop, hunt, high, drop. Where's the target? Maybe somewhere in here. Or you take your normal daily flow. Higher level long holders, HLLH, are going to be trapped here in this big consolidation. Because what happens? Oh, I missed that up. I missed that up. I missed that up. I ain't missing it again. I'm getting long. Everybody's long. Time to reverse the market, right? So the calculations we've been talking about is that you could know this way in advance. You could know that this was coming once you get your first anchored area and start pushing, right? It's talking about the 50% pullback and all the things we've been talking about going over and over again, right? So let's tie it up together. Here's someone that submitted me some homework, and it's perfect. You can know the directional move, form your directional bias, and look for trade locations based on this information. Right? So ADR is 90. What are we looking at here? You would subtract 90 pips from the high swing of the day to the low. Right? You would take this number and minus 90, and it will give you some number down in here. Right? You want to get long on this bottom, perfect double bottom. You want to get long and have an upside target? Okay, if you're not going to get long right here, where would you get long? Let's say you're going to get long in the Apex Nader thing, which is a fantastic trade, my favorite trade, by the way. It's the first pullback after the trend reversal. It's the best place to trade. That's why it's called, anybody? A safety trade. Okay, favorite entry? Cool. How do I get an upside target? If I'm looking for a 1 ADR, which is 90 pips, I'm going to subtract this amount from this amount here. I'm going to subtract that. For argument's sake, it looks halfway. Let's say it's 45 pips. Okay, so I'm going to enter here. My upside target is 45 pips. Is there obstacles in the way? Yeah, there's a pretty good sized mayonnaise right there. I might get a bounce trade on that. Maybe I want to pull up at the Mayo. I'm not leaving too much left on the table. That's how you calculate it. That's what all this math bullshit is about for the last 3 weeks. How to use it.
Cavalry.
All right, day one, we got our trade. Now we have an anchored area on the chart. We're looking at the blue tracers. The dealer's trading way off the tracers. All right, I take yesterday's tracer projected forward, and I take the tracer now and lay it out here. Right, I'm taking, look, this is a zone. This tracer from yesterday moved over here, that's a zone. Now, what does it look like to me? This structure down here, which was yesterday's structure, is left in the dust. Everything's consolidated higher. Everything's consolidated higher. I like it. The dealer trapped lower level short sellers or short holders. LLSH, right? Trapped. How do you keep them hurting? You keep moving price away from them and messing with their day, running them into margin trouble. Okay, what's my trade coming out of here? Day 2, safety. Okay, how about a safety on a safety? A safety trade on the safety day. It's hard to go wrong. Okay, this ADR says whatever. I can't read it. I got to get glasses on. Okay, 62. ADR is 90. Okay, I'm looking for a pullback at AR mid, right? Right around here in the flip. Look at this zone right here. Right, it's not a perfect drawing. I got, what's my confluence? I got day open right around here. I got the moving averages. I got AR mid. Now I need a pattern on the AR mid. Okay, what's my projection? Okay, when I come to the terminal, this box is 60 pips. Okay, what do I got left? About 30? Okay, but I'm shifted back into the box, so I can add back 30. I got about 60 ticks in front of me. Okay, how do I get a target for that? Okay, I'm going to get long here on leg 2, 1, 2. Micro M on the mayonnaise and the water. My first worry is to get through blueberry. But I like it because blueberry's flat and it's just going to act as some kind of initial barrier. So what happens? It hits blueberry, pulls back. Let me clean this out so you can see it clearly. This is my trade idea right here. Okay? It hits it, pulls back, but it also pulls into my second leg. I get picked up on a limit order, stop below the Mayo, and I'm good to go. When it makes the second run, it doesn't reject so hard. The tracer, right? First time it hit, it rejected clean, gave me my apex book flip into my 1-2 leg. Now it's going up here, it closes high. It comes all the way down, stays above the blueberry, and closes right around there. Now it breaks. Now I got an edge and a little wedge. There's my upside target going into the end of the session. Look, vampire box, time for me to go to bed, I'm taking my money. So I'm adding back, I'm taking the 60, adding back 30 in my favor, and I still had 30 left. I got about a 60 pip target. I'll easily squeeze out 25 to 50 in that. Now what do I got? Day 3. What do I expect on day 3? Stop hunt, low rise. The dealer's handed to me like candy. Day 3 is also vertical day. What the hell is a vertical day, Steve? The market is so aggressively pulling away from you, either with a news trigger, straight up, not where you get this consolidated slower rise, or this consolidated slower rise. This is all part of accumulation, and this is hardcore punishment. Why? Lower level short holders are trapped. Structure, blue tracer, blue tracer, blue tracer, all this zoned out. Now this, look at this one shifted up. Okay, the zone got bigger. All lower level shorts are in these areas. Stuck. Now what? Run it hard to the top, maybe exceed ADR, but don't be greedy. Get your number here or EOD into the box. If you catch a move shadow to shadow, it's time to get out. Right? You have London Open, winding down in the US. And sure enough, hits the shadow, goes into the red, consolidates hard. Now what? We expect a sell side book, but they got to collect some money. They got to do this. Right? Could you have taken a long there? Probably, but the target would have to be back to the tracer, but it's unnecessary trade. This is the trade. Look to sell highs or break up high, pull back below, right? Break up yesterday's high, wicked it, pull back below, hooked it, gone. There's your trade. What would your target be here? This went off in the US. This is common, right? They hold the end or all of US, all of Asia. They get aggressive in London, but they show longs. Then they trap high, spike, and pull it back. And in one candle, they took back all this work and trapped all higher level long holders now. They ran them up, took them back. So anybody that, we always talk about this, anybody that took a long position in here and didn't get stopped out by that is now trapped. How do you know, Steve? Draw a line. This is the consolidation zone. This is where the book action is taking place. Offloading and onloading of buys and sells until they balance their book. Run the stops, which gives people on the buy side some hope, and it spikes right off of that number and shifts right through the zone. Hours upon hours upon hours, over within 3 bars. You understand? That's a telltale sign. Now, Steve, I want to get long here. How do I tell? Okay, I'm sorry, I want to get short here. How do I tell? The last swing point. before the accumulation, right? You got to get below this. You can make the argument to get below here, but this is the last place, the last swing, and the last swing. These would become your areas, right? You had a rejection high side here. So if it shifts through and closes below, then you can sell the first pullback of the trend reversal. Buy or sell the first pullback after the trend reverses. How do you know the trend reversed? If you don't know, you didn't watch my videos, man. 1, 2, 3, high side, accumulation, hit the stops, drop. That's how you know. I've been drawing this since not 1999, but pretty damn close. And it never fails. You can always at least scratch on this. And if you can't scratch on this, you better go back through my videos. All right? Any questions? That's what all this math is about. You could see this coming with math a mile away, right? I didn't talk about target here. You got your low swing, add 90, there's your target. So you make entry somewhere in here or on a break above here. Depending on, you subtract this number from this number. Like to make it easy on me, let's say that's 60 and this is 30. Okay, so if it took me 30 pips to get the shift and in my favor to get in, I'm in here, I got 60 left, I'm going to target 50 into the box. The only thing in my way is this. I expect a rejection here 100% of the time. That's what it do. Right? It do how it do. That's it right there. Don't be fooled by that and think it's a sell side. This is what it has to get through. Right? That's what the line represents. It's got to get through that. And it makes an apex, goes through, retests it, continues higher. If you got in here and took here and went to bed, I'd applaud you. You're done. If you got in here and held it for the full boat, that's okay too. But what's a full boat, Alan? What's a full boat? Full boat ain't 150 pips because you're not doing the math. If I got 90 ADR and I burn 30, 60 is my top I can expect to get. Does it run crazy and give me more? Yeah, you can't predict that. But if you use the math consistently over and over and over again, you're going to take reasonable limits and not because you got into it expect to go 15R. And I'm talking to a handful of guys, but everybody at the same time. I get this shit all the time. They send me stuff, they go, it took 5R and it went 15R. Okay, where were you in the count? What was your day? Well, I don't know. Shame on you. It's your job to know. Your job is not to come up there and pull the trigger. Your job is to know the business inside and out, like the back of your hand, and this is part of it. I keep losing and taking 2R trades and getting stopped out for 3R. What's my problem? Your problem is you ain't mathing. It's math. It's 2-to-1 risk to reward minimum, not 1-to-1. You're taking 1-to-1 because you're scared. If you know that the pair is going to offer up 90 pips ADR on a regular basis, why are you taking 10 pips with a 15 pip stop loss? That's worse than 1-to-1. You got to be impeccable to make money like that. You need to skew the numbers in your favor. And I'm going to talk about that with backup orders and stuff, how to get there. But this is what you're supposed to be doing. You're supposed to have a rough idea. Everybody walks up to the terminal and goes, that looks like some shit Steve talked about one time in the class. I think I'll get on there. Got lucky today. Tomorrow you come back, and what happens? You sell the high when the price is still going up. And then you can't understand what my problem is. All right, we good? Any questions? Ask me now. Ask me. It's really this simple, but no one's doing it. I only got a handful of people, and this was a clean chart, that after the stuff we talked about sent me over these type of homeworks. This is how you use it. What was all that about 2 weeks ago, Steve, with all this plus or minus 180R and all that? This is what it's about. If I can anticipate what it's going to do, and by the way, what do you think this shit was coded for over here? How far are you off the low? Right? You come over here and you go, okay, I'm 30 pips off the low. What do I have left? I got about 60 pips left on a 90 ADR instrument. Okay, I'm looking to get long. You know what? I like a flip above, pull back into these moving averages, right into the shadow. That gives me what? Gives me a shift, a timing element, right? Time is part of the elements of the trade. Going into London Open, right? Following moving averages that are moving up, following price action that is getting boxed in at lower levels. I like it. If I wanted to lean this on something to the left, what could I come up with? Maybe some swing point over here, more or less. Bookmap levels type of thing. If I drew it correctly, it kind of pins right in there. That's a good idea. So now I can expect where the reversal is going to be. Right? On an intraday chart, the label on this should be -1 impulse. Right? This will be +1 impulse, +2 impulse type of thing. And it's fine. This is good homework, man. At least he did it. Okay, does it start to make sense? It's the thing is, like, people tell me, oh, you make it look so easy, or sound so easy. It is. It really is. I went to high school. I didn't take any advanced math or anything. I hated it. I was lucky I barely got through geometry. And I'm talking like years ago, before you could Google shit and cheat with your phone. You know? I got probably straight C's. I had no interest in it. I didn't see the use for it in the world. But basic math, if you're dealing with money or pips or whatever, you gotta be able to add and subtract, man. And it's not hard, but if you're not looking at a chart, walking up and doing this, you're hurting yourself. You can know what the upside potential is every single day in any instrument, just by knowing the ADR and where they make the low or the high swing. Anything. Go to GJ right now. What's GJ's ADR? 100, 200, 150? Who the hell knows? But just look at where you are with your Asian range and say, okay, the Asian range is 60. It's coming off the high side swing. It stalls right at the mid ADR in the day open. Add 30 back to what's left. And you got yourself a 60 pip possible trade. That's it. It's easy, man. And if you're taking fixed numbers, some of you guys are taking +10, +15, that's okay. But the caveat is this. You can't be taking 10 with a 25 pip stop. You can take 10 with a 5 pip stop. Where I'm from, that's still 2R. You could take 15 with a 5 pip stop, 3R. That's how the math, because that means you can afford to lose 3 trades and still be even for the day. Right? Then it comes back to the block trading. You do your 30 block. Right? Your 30 block is 10, 10, and 10. You just trade it. You get your win rate. Right? Let's say you're 6 out of 10. Okay, if you're 6 out of 10, 6 times 3, 24 out of a 10 block, you're 24 out of 30. Divide 24 into 30, you'll get a percentage win rate number. Couldn't tell you off the top of my head. But wouldn't it be 60%? Right, it's going to be probably like 0.6666 or some weird thing on the calculator, right? Okay, so now you're a 60% trader. Take the 60%, plug the values into the spreadsheet, and use compounding at each cell and watch to see how rich you become. It's mind-boggling. And if you can qualify for a couple $100,000 or have 2 accounts going with a copier and start plugging those numbers in, it's lights out. All right, there's a guy in the group that is punishing these guys. And what he had to do was he had to slow down and do 1 account at a time, half of the month, and the other account on the other half of the month, and take a check on the first one and on the second one. Don't ask me because I ain't giving it up and you ain't hanging out with it. It's just math. All right, so I was talking about cycles. Let's get all the way down to the microcycles. I want you to see some cool stuff. So we looked at, right? The high of the week, the Asian range of the week. Gives you ideas where the midweek reversal might come in, the counts, that type of stuff. Then we boiled it down to, right, first it was ADR, then we boiled down to impulse. Now we can look at micro impulses, right, which is this stuff. Bookmap stuff, right? They open the book, make a hook, flip the book, make a hook, right? That's what we're talking about. That's the theme. All in here, all these little things. Okay, so now you could trade literally on a micro structure inside of candles. Right? I picked this because I wanted you to see something crazy. This is the exact reason you don't roll over. So here you are, high side spike, right? Coming into the end of the day. They make the perfect M. They shift the zone. And then look, 1600, the dealers pull the liquidity and go home. Liquidity goes bad. Where's all the liquidity? Liquidity stabilizes the market. Without a little bit of blue or anything, price goes crazy. This is a 30 pip spread from here to here. If you were holding for rollover, you are out. If you lifted your stops and your limit, you would have survived in this instance because it came back. Sometimes it'll do that and open up here. And if you're sell side, you got gapped open. What would have been 30 minus whatever, 1, 2, 3, 4, 5, 6, 7, 8. So you would have got gapped open 22 pips, and you would have been down 22, or stopped out. And if you lifted your stop to roll through the open, shame on you. Doesn't always work like this. A lot of times it'll do this and then go like that and stay there, and this green line will come back to here and close the gap. And that's how they make that. Liquidity black in the book means nobody home, nobody buying or selling, they're done. And this is market close at 4 p.m. Or I'm sorry, 1600. All right? So don't roll over. Okay, so anyway, back to microstructures. Right? I had that little blurb. Might as well give them your money now and cut out the stress and anxiety of holding it over. That's why you don't roll over. Funny, not funny, right? Okay. So I want you to look at this chart, and I want you to notice all the little holes and flips. This is the stuff I've been drawing for you on the bigger time frames with candles. Okay, see them. Consolidation, they break the lows, tiny little hooks in here. Tiny hooks in here. They take out the low, but then the next swing fails and they come back. So when they break above, you should have been stopped out or holding short here. When they do that, it's very likely they're going to reverse. So where's the next place to get in? I drew it. It's the flip above and the hook back. Okay, over and over. It's all the same shit, man. It's all hooks. Okay, now, in your mind, imagine what the candle overlays look like and draw them in for me. Pick anywhere on the chart, fill them in. There's no wrong answer. I want you to conceptualize this in your head. What's going on inside the candles on a micro level now? Okay, we're looking at macro, intraday, and now we're looking at micro stuff. Okay, you ready? Draw it in. I'll be quiet for a minute. All right. Take a screenshot of what you drew and email it to me, man. Come on, do it. I don't care. I'm not going to make fun of you. I want to see what you got. You ready to see what it looks like? It's very peculiar. All right, quick. 2 questions. Let me look real quick. Hold on. Okay, is trading the break of the level the same as waiting for a zero entry at a micro MW? No, it's not. trading the break of a level is a breakout trade, right? So let me see somewhere in this chart for argument's sake. Let's say you're like doing this, right? And a breakout trade would be price gets below, you sell, price gets above, you buy. It's manageable on a micro level, you can do it. But what usually happens is the stop has to be over here, right? Depending on how far this range is, what time frame you're trading on, that might be too risky. But the thing is that a lot of times, and almost always, right, this is a realistic breakout trade. Price goes up, you have it's a buy stop, by the way. You can't use a buy limit. Buy limits are below the market, buy stops are above the market when it's going, expecting it to go up, right? So a lot of times what happens is the dealer spikes through the level, you're going to be long right here, right? Because look, they didn't fill the bubble till here, so you got slipped. That little spike right there, there's no orders. The first order on that breakout is right there. Then they fill orders on there and they drag it all the way back. It's not that deep. You can count every little strike as a tick. But roughly, let's just say it was 10 ticks. So people get in here thinking they got it. Maybe they put their stop in the thick of it, and they get taken out. The idea is, right, when I started looking at this book shit, I knew they do that. It's a fake out. Right? I knew they do that. It's a fake out. So when they open the book, wait for the hook. They open the book, right? Look at the background. Let me erase it so you can see clearly. Look at the background. The book is black. The first thickness that shows up is here, white, and then orange and yellow. That's stopping volume to make that turn bar, right? This is a turn bar on a microscopic level. So now, when they make the hook, you buy the hook like this.
Organic skin care brand for men.
1, 2. You're here on buy limits with a stop right
facial
there.
application.
How do I know it's going to be?
all the products
You
that I
don't,
need
but
to
you
make
understand the
this
concept
package.
that it should more than likely hold. If you use a 10 pip stop and you've been using a 30, you just increased yourself 3 times. Right? So you increase your R value threefold just by making this little nuanced adjustment instead of chasing trades into the highs, the high swings. That's the answer to that. Okay, now let me get back to these candles. All right, take a picture of what you got before I show you. It's crazy. It's weird. All right, you ready? That's what it really looks like in reality. That's why I take them off of there, because it's confusing. So now, let's look at this green candle, for instance, right? Or this red one before it. It just has a very short set of bubbles, right? The wick, low volume, went in there and got pushed out by this orange stripe, right? Candle opened, went up, green, and then turned back inside out and landed right there.
What
And was
type of
probably
facial
blocked by
product
that
should
heavy
I
orange
use?
stopping volume.
What type of facial
But while this candle was forming,
forming,
price is going up and down, up and down, up and down, right? That's what it does. Then it closed, and this candle opened. So the pullback somewhere in here has to be associated with this. Then price went up, took its time, went all the way up, pulled back, and closed. Then this candle opened over here, and it went up, and this is attributed to the body and the wick. Right? It went into the thickness. Look at that orange stripe right there. This orange stripe is pressing the body down. Then they have a few more orange stripes in here to cap it and hold it. Right? So what did it do? It went up, and it was green. It opened here, went up, and was green. In order to create the wick, right? Look how the liquidity's gone, and it starts moving in. It's like almost like a fog gets in there. Now they pressured it down, and that becomes the high swing of the day. Then what happened? You're watching the candle goes all the way down, it pulls back a little bit, tricks you, oh, it's going to turn green. Then it goes down and closes right there. And that little red bubble, right, this swing over to here, pushed it. Then this one pops open right away. There's the liquidity right there. It caps that one. It's over here, and it goes down, makes a hook, goes down, makes a hook, goes down, ends up right around here and closes. So these little nuances is the same shit on a macro level. That's tradable. And if you start looking at it crazy, you'll have like 3 pushes inside of the actual candle, right? You can technically see the label 1, 2, 3 in there. It makes a baby W and pulls back on the open here.
Anti-aging facial cream.
So if you're a scalper and you understand this, what's going on, you could sell here and be out here.
Explain
with
to
10 or
me
15 ticks.
anti
Okay, next candle, what happens?
What is
Candle
involved
opens
in it? What
green.
creates it?
Right?
How does it work?
Goes all the way up, green,
What
looking good,
ingredients?
and then the little consolidation, push it back, hook it back, done. Have you ever been in a candle and it's green, right? And it's pulsing like that, pulses. You go, it's going to do it, pulses. That's all this little order flow right here. That's the inside structure of how the candle is formed with the little tiny order flow bubbles in the execution. Right? The black areas on the chart or the lighter gradient is orders being absorbed or absence of orders. Like up here, there's nothing. Nothing. All gone. Well, why? They move the orders down in the book. Once their orders are gone, they literally chase the price or squeeze the price into lower levels. So the patterns, right, you could call this an M basically. And when it breaks below the previous swing, which happens to be, right, how do you make a turn bar? A bunch of liquidity. You make a turn bar with a bunch of liquidity in the book. How do you make a turn bar? How do you make a high of the day? How do you make a high of the day? You put a bunch of liquidity in the top end of the book. And then it creates a turn bar, a turn, and a turn. On a higher time frame, this is one bar. This and this is one bar. Right? On a higher time frame, it could be these three bars, 1, 2, and 3. Let's say, for argument's sake, this is a 5-minute chart. So this is 5 minutes, 5 minutes, this is 15. What would a 15-minute bar look like here? It would open high, go down, come back up, and then drop. And you would end up with a set, maybe something at a bar that looked like this, right? Maybe a higher wick on top because it got rejected right into the orange. On a different time frame, it might look like that would be the green bar going up, and then you get this big outside bar that closed below.
Please add anti-aging facial cream.
Right? On a blue tracer, that's tradable. And then inside the little nuances, the little hookbacks. It's really fascinating, man. If you don't love this stuff, you're in the wrong business. It's crazy. Right? Candle opens, goes down, pulls back a little bit. Oh, it's going to turn green. Shifts hard, pulls back a little bit. Open the book, make the hook. Open the book, make the hook. Open the book, make the hook. Inside every little even candles. Every little candle. Okay? No worries, bro. Happy to do it. All right. Look at another one. Okay. Inside the candle, you have a W. Inside the candle, you have a little open the book hook
This must
to the
be
top of the candle.
for
This is weird, right? You get a major pullback. So this candle probably teased you, green, red, green, right? It came all the way back. But if you zone this out, right, the top of the liquidity, it's pretty much a breakout pullback. And this is another reason why you don't take breakout trades, right? You take them, but you don't take them the way everyone teaches you to take them. They tell you to get in here, right, with a buy limit when it breaks out of the zone, and then sit through all the shit and take the trade. I'm telling you, that's not the way. That's the way amateurs do it. The way you're supposed to do it is to find the spot in here, right? Maybe you zone this out. Maybe the top of this candle. It's hard to say. Look, I'm looking at the liquidity. I know how to do it, but I can't do it with include the candle. It's weird, right? I would take the low swing right here and box it up for about 10 pips. Price would break out and hook back right there, and I'd be long buy limit order, stop right there. And let me see, I would go, it's hard to count these. 1, 2, 3, 4, 5, 6, 7, 8 maybe. So I usually minimum draw a 10 pip box. If it's less than a 10 pip box, treat it like a 10 pip box and just draw it out. Right? So it's easy because, oh, Steve, price is going up, it breaks above and hooks back. And I'd be in right here, have a little bit of draw, and it's gone. Same thing, top side, right? It's the other piece of the chart, same stuff. That's where the reversal comes in. right? So this is that FTR zone, right? You have the outside high, and then failure to return stays off the high. You get like a consolidation at lower level. People go short there, expecting, right, an outside high A-frame or something like this, and then they hit it and they stay low. Then they go back and make one more pass. That runs the stops on all of these traders, and then you get below the apex nadir thing, and you get the hook back. Right? On a micro level, this is where, by the way, this is where I started drawing boxes from. Forget all that supply, demand, all that other shit. People draw these boxes all over the place, all the stuff they're talking about. This is how I started drawing boxes, with the actual order flow. It made more sense to me, right? It would make sense that this stopped right here, and that this stopped right here with a little bleed on the wick. It makes perfect sense when you box this in, right? So this would be a trade location. I have all the liquidity in the book, right? So now let me zoom down to a microscopic level, and look what I got. I got a break, 1, 2, on a microscopic level. Horrible 2, sorry. That's a micro M. You could go short right there with a stop right there and call it a day. You'll be out with 10 ticks in 5 seconds. Before this candle even finished painting, you're out. Right? If you look what happened, is technically, I use this, right, as a leaning post. The open of this candle opened here, and it did all this inside the candle and just went straight down. And notice how it ended in a hook, right? They open the book, make the hook. On a candle, you can't see it. It ends as a wick, right? Here's the hook. It ends as a hook, but it's the wick. Right? This, I don't know if you noticed this spinning top bar. How do they form that? Look. Hook it. Same thing on the bottom. They hook it and go back up. You guys got to be seeing this, man. You got to be a little jacked. I mean, I could talk about this stuff all night, but I'm losing my voice, as always. All right. So now, let me find the putting it all together slide. That's what I want you to do. Where's it at? So, all right. So cycles exist everywhere. We looked at the higher time frame, lower time frame. We looked at microcycles. So to wrap this segment up, you should be working on cycles and be crystal clear about how the cycles exist. So now, how do you tie all this understanding of cycles and trading together? That's where everybody starts having problems. So I talked about this a while ago, but I want to mention it again. I want you to go to babypips.com. And there's a psychology test. And it's going to tell you what type of trader you are. I think there's another test, the Briggs-Myers or something. Some of you might know about that. You could Google it. I was going to say Briggs and Stratton. I'm pretty sure that's a lawnmower engine I had when I was a kid. But anyway,
visit my site, dailybargain.net.
Anyway,
and
take the Baby Pips test, and find out what type of trader you are. And it doesn't change anything. The process is the same. I just showed you. You could trade higher time frame charts, find the cycles using ADRs. You could trade intraday, intermediate charts using impulses. And you can trade micro charts using impulses. By the way, that bookmap stuff will show up on a 1-minute chart. I heard people say to use a 30-second chart. That's a little overkill. 1-minute chart's clean, and you can monitor the 15 or the 5. Right? If you want to trade scalping, smaller takes, you would look for that. First reversal on the 1-minute chart. Get the pullback. It's going to be a smaller pullback. Tiger stops. Jim loves the 1M. But after you find out what type of person you are, the thing is like, whatever you do, I don't care about trading, anything in life, it has to resonate with you. It has to be something that makes you feel good inside and that you're comfortable doing. And sometimes it just takes a little work to find that spot. Right? First time you ever worked out, you sore cell, you decide to run, ankles hurt, knees hurt. You're like, I don't know if this is for me. Fast forward 6 months later, you're burning up tennis shoes every 6 months or every 3 months. Right? Wearing them out. Soles are losing their bounce. The difference between an amateur and a professional is practice. It really is. That's what it comes down to. and having a deeper understanding of stuff and taking the time to not just go, see if the shit's boring and tapped out. Some people left. They don't like this shit. It's okay. They always say they're going to watch the recording later, but they never do. All right, so take your test. Find out where you're at. Find a setup that's easier for you to see and identify. Whatever it is.
Expand these prayers into
breakout
paragraphs
and
finish
whatever you like.
the completion of all of the Psalm
and mark it up relentlessly
119
so you can see it in
letters
your
from
sleep
A
blindfolded.
to Z, or whatever the Hebrew alphabet is.
Then I want you to learn how to execute a demo perfectly to the tick. If you're going to use limit orders, you need a demo that. To find the spots, the trade locations of where it's going to happen. Right? Practice hitting your TP, whether it's 20 or 220. I don't care. Whatever the number is, just use proper risk management. Don't be sending me 1R bullshit. You want to start out with that? That's fine. That's you're afraid. 1R means you're afraid. Right? When you look at it, 1R, it's IR afraid. It's IRA, man. It's because you want to hurry and get out to have a win and a mental victory. You ain't going to make money doing that shit. It's mental. Get past the mental block by doing it. Seeing, man, how many times you taking a 1R trade and it goes for 50R? Okay, that's a sign. 2R, 3R, I can do. How hard is it? Think about this. If you're going to get your stop down to 5 pips, you got to do 15 or 20 to get 3 and 4R. If you're going to get your stop down to 7 pips, 7 times 3 is 21. Can you get 21 with a 7 pip stop? Yes, you can. Especially if you can draw the levels on the low body parts of the candle. So, I think I forgot to mention this. Let me go back a second. All right, I'm looking for, here we go, looking for a clean spot. So, since we know, right, I want to mention this real quick. Since we know that this is where the liquidity is in the book by the body and the wick, that's where the boxes came from. Right? There's stopping volume there to make those turns and to press. It's called pressing, right? This is a heavy press over the top because what happened was price was going up. They need something violent to hold it off. There it is. That is a greater force of orders and liquidity in the book met against a couple of retail guys trying to push price up in these little bubbles. Right? If there's 5,000 orders here, there's probably 50,000 orders sitting there. They didn't get all 50,000 off.
I need you to write a 2-paragraph prayer for each of these sections.
Make that turn bar and
use as many characters you need and as much time.
So if we know that's how they make a turn bar,
all of
with
it,
liquidity,
from 1 to 176.
How they make a turn bar, with liquidity in the book, then we can box up every freaking area on the book by just looking at price behavior. Okay, right here, look. Isn't that ironic? It's all red. Right there, there's a green when they broke through this level. Now, I could come back, let's say on a different chart, this was a couple of candles. That's my V. Open the book, make the hook. There it is right there. That would be my entry. Right? That's an anchor high, flip below, 1, 2, and then I'm taking at least a measured move. Right? This times 2, whatever that is, out here. Take this stick, project it from here to here, and there's your TP. So if this first impulse move was 20, I'm targeting 20 on the other side, and this is so freaking tight I can use a 3 to 5 pip stop. Steve, look at that candle, it's all the way up here. It was all the way up here, it's not anymore. Right? Candle closed down. And a ready move. 1, 2, 3, 4, 5, 6, 7 ticks off of my high swing entry. So maybe I got filled in front of the box, I'm up 5. Next candle opens. Down here, I'm going right to TP with little micro hooks in between. Makes sense? It's easy work. It's easy work. But you have to do the work. You have to look at these little nuances. The easiest thing you can do is put a line chart on your platform. A line. and put it down for 1 minute and thicken it up black or red or whatever color you like. Watch it draw these little nuances. All right. Any questions about this stuff? You just got to do the work, man. So back to this. Practice hitting your TP. If it's plus 20 with a 5 pit stop, plus 20 with a 10 pit stop, that's 2R, good enough. First, limit yourself to 1 or 2 pairs and get really good at it. Then I want you to expand yourself to 4 or 6 max. I look at a handful of pairs. That's it. 6B is GBT and the futures equivalent. I like NQ, ES, crude oil, and gold. That's it. Do I get to trade in those every day? Absolutely not. I get the cleanest setup that shows itself by coming in the office with enough time to allow myself not to choke and panic and have to hurry up and grab something because it's 4:05 and the market's moving. It's all in the prep, man. It's all in the work you do here, and it's all in showing up on time and prepping properly. That's the business. If you don't like that, then you don't like the business. Right? You want the action, you want to trade. Get kicked in the teeth a couple days in a row and blow a few accounts and have to pay reset fees. And then you'll say, well, maybe I should do the prep. All right? When you get to the next step, I just said it. Take the 10 block 30 challenge. Import your data.
So let's be clear, because you lied.
What do I mean by how do you improve? You take the spreadsheet. I'll do a class on this soon. But let's say you're using a 10 pip stop. Okay? And you only got stopped out 1 time. Now, you go back through all your trades, and in the first 9 out of 10 block, you notice that with a 10 pip stop, the trade that got stopped out cost you minus 10. But every other trade was a clean entry and never went more than 4 or 5 against. Now, 4 or 5 against means you can bring that stop in somehow, right? Because you never threatened. The one you got stopped out, you lost. It was 10. You were just totally wrong on the entry. You could live with that. Put that shit behind you. But if you're getting a little 4 or 5 ticks draw and you're using a 10 pit stop, how could you improve that? You can cut it down to 7. 7 times 3 is 21. Going for the same amount of numbers, you just increase yourself to a 3R trader. What's the difference? Is where you see the edge at. And the edge gets refined. This is the chart from last week, right? This is a really good drawn box, but the edge gets refined from the wicks down here. From the wicks that are showing. If you get a push through like that, and the box holds, right? This would be the proper box. You'd go after the first wick gets rejected to 1, and you would include that, and you try to get a tighter entry in a bigger box. So basically, it's a box in a box. You have a box, and it's 10 pips, right? Okay, if you're worried about getting filled, if you have a lot of contracts, you want to front run the box, stop down here. It's hard to change that. If you're trading a lot of lots and you want to split your order, you can do that. You can go 25 on the front, 25 mid, stop out the structure, a couple ticks below the bottom. You'll get 50 lots off.
Part of your trading account or more. Always use only discretionary funds when trading. Never trade any market with money you cannot afford to lose. And whatever you do.
So the question is, doing all this work and refining your entry. So
our Excel
you notice that first bar
risk above the waterline
made a little spike like that. That's what we want to hammer.
Might be necessary.
Okay, well we know that the strikes are in the books on the wick.
So let's say
you
you
can go like this,
$50,000 account.
expand in your mind the strikes, what they look like.
Every single trade.
Now you just refined your box into a lower box. So
Actually,
instead of
it's
front running here, right, first
if you
thickness of
lose
liquidity.
9 of
That would be your limit order, and just cut your stop in half. Just a little bit more patience in drawing, taking the time. All right, last slide. Almost 8. I don't want to keep you guys all night. I can talk about this shit till probably I die. Can you get 6 to 10? If no, keep practicing. If yes, go to the next step. This is for backup orders. Cancel your backup order. I think this is for you. Say, hey, this is for you. Cancel your backup order and go full position on one area, okay? So, if you notice he has backup, limit order, and he has his entry order. So the goal is to get in here and turn this into a stop loss, and he just increased his R values, right? Then the goal would be to understand the nuances. Look over here, look over here. There's the bleed. We know that this is a strike of the book, right? We know that they bleed into the book, they flip it and bleed into the book on the other side. If we know there's bleed on both sides, most of the time, then we can execute by refining this box on the front side, looking for an entry. Does that make sense? So you start moving your stop to your backup level, which would be here.
Okay, baby, hold on.
Lather, rinse, repeat. Just like shampooing your hair, you start cashing out. All right, I'm going to end it here. Any questions, email me. I enjoyed the session tonight.
Hold on, baby. I'm coming. Hold on. I'll get you food, baby.
And I hope I steer some of you in the right direction. Good night.
Here you go, baby. Lotto. Come on. Come on. Here you go. Hey, don't spray on there.
Starting with our disclaimer, trading involves risk of loss of all or part of your trading account or more. Always use only discretionary funds when trading. Never trade any market with money you cannot afford to lose. And whatever you do when you start trading a live account, I want to make sure you are using our Excel sheet. Okay? So scale the risk above the waterline. Quick, brief explanation of this might be necessary. Starting account balance, let's shoot large here. So let's say you start a $50,000 account. Your first trades, every single trade should risk no more than 0.25%. Actually, it should be exactly 2.5%. If you lose 9 of those, this becomes the area where you rethink your trading strategy. Once you get above your starting balance, which is this white line, the water line, you get into the area of a 0.5% trade. And as you build this up, as you hit these milestones, when you're above 5%, and this would be your balance, so you can actually track your balance. When you get to 50,775, then you're going to 0.5. When you get to 52.5, you're at 1% and onward. Okay, until you get up into 3% per trade at around 66.5K. And what that does is it allows you to have fewer trades per week, and you still maintain your inventory. The same exact thing goes if you're on a smaller account. There's no reason not to do the exact same math. Okay, so tonight we're going to talk about math quite a lot, and I wanted to pepper this in there because not enough people are using this, and I want to make sure if you're brand new and you're not sure about risk and it's an issue for you, make sure you understand the fundamentals of how to set lot size based on your stop loss distance. Okay, so if you open an account with $1,200, you could suffer 9 trades and it only goes down to 1,173. You scale up as you build your account. You scale up the size of the risk per trade, right? So in this column, we have the risk per trade, and then you have how many trades a day until you walk away. So generally speaking, we're looking for 3 trade attempts per day. Right? So this figure right here would pull you back to the previous line. That's why we adjusted these numbers. These are adjustable. You can go in there and tweak them, but I suggest leave them where they are. I spent some time making sure that this was actually very sound. So notice that if you're at this milestone, 1416, and you lose 3 trades, it takes you back to 1260, which is this next milestone. You never jump more than 2 spots. Basically, you should essentially only jump 1 spot if you hit a daily walkaway threshold. You'll see once you use it, it makes a lot of sense. All right, so I want to make sure people are aware of that tool. As we get going here, let me just as well, I'm going to pop the forum up and do a little modification in there, just so everybody knows where that tool is. I know a lot of times people get a little confused as to where everything is in the forum, so I do apologize. We are traders first and teachers second, and I guess forum admins third. So we come down into daily market review. Any tool that I bring to the method, doesn't matter what it is, an indicator, an Excel sheet, whatnot, it's going to be under this AFP tool. And these last 2, I did not make a link for it at the top, but I will. So let's do this. So scaled risk above the waterline spreadsheet. And I guess I don't need to do this with you guys here, but I might as well because it's something that's super important for your trading. Both of these spreadsheets are going to be super important, so I want to make sure you know exactly where they are. And we don't cover navigation in the forum quite enough. So here's your London pattern checklist. So let's get the sheet in here, right? So I'm going to modify this, and we'll just put it right above all this. And those are no longer new, so understand that. Let's do this one. So new and EW, and then let's drop that in there. We'll go back and grab the link for it, which is right here. And then I will post the link directly to you guys here in GoTo, but it's here. Okay, so that, and then that, and then let me drop it to participants here live in GoTo. Copy. We'll use Patty's thing to anchor it to, and we'll send that link out to you. Very important to have that. And then, of course, the other one that we'll get to a little later. So new scaled risk above the waterline. Let's make sure all those are bold, so it lines up, and then we're good. We're good to go on that one. Okay, so we'll do the same. I guess I didn't do the here part. We'll do the same with the other sheet when we get to it. We're going to cover the other Excel sheet, which is in the process of evolution now. Whoops. Let me just go back and figure out what I did here. So that should be correct. Oh, I didn't have this thing at the end. Sorry about this, folks. But again, we're traders first. Forum admins third. Okay, there we go. Whoops, didn't like that one either. What am I? Your session timed out while posting. Okay. I'll come back and mess with that and make sure it's correct. But you get the idea. You know where it is now. Everybody that's here will absolutely make sure I'm watching AFP tools. Top link will fix that. Oh, it did fix itself. That's addition. Okay, we'll post the next one. So let's get to the content here tonight. Welcome everybody to the DMR session here for the 26th of November, 2019. Last days of extreme formation. Extremely trade anything of interest. They want to talk about
vector that defined this top edge, and then once it
and
started
as you think about that, let's go out
any material to the left, it then became
we were in level 2 short,
relevant or possible away from
night.
key considerations.
Euro CAD.
Okay, we see this outside structure at the end
We were
of the day.
in L2 short. We had our 5200 pointed down
in the pre-market last
We got the break of the
You can
Asia
see how they're
range.
coming back to fill
Last
that
break of the Asia range
into this
is
zone
twice.
area. So what I like to do with this pair specifically is I like to
Okay, so let's go back to how we're going to fix this, besides trying to stay out of the medical loop. Because when you get into synthetics, a lot of times you have side effects of the synthetics that are cumulative. It might be 10 or 20 years around something. Sad to say, it'll damage you. And they don't, and they'll say it. And the numbers are there. Anyway, so try to get non-synthetic as best as you can. That's going to help this figure as well. All right, London matters. We began in this section here last week, having taken this away from peak. You can see the inverted hammer.
Mercy, Lord. You are the only one.
Saying 3:30 a.m., 9:30 a.m. We live at SFC. Ray just talked about the same thing as
This is ridiculous, man.
correctly.
Just be on me. You give me hope.
The broadcast is now